Today, I would like to share with you one of the most powerful and simple trading strategies you will ever see. This isn't a random strategy floating around the internet. In fact, most traders don't even know it exists. I learned that strategy from a professional trader in Germany over 8 years ago. While I was working for him, many traders from all over Europe came to him to learn his methods. This strategy has been one of my secrets behind many of my big gains. When applied right, it will let you know key turning points before anyone else. And the best part, it's happening every single day, usually in the first hour of the day. And you don't need any indicators, wild technical analysis, or drawing dots and lines on the chart. It also works perfectly in volatile and uncertain markets. And it has nothing to do with guessing or hoping or believing. This strategy has been backtested for over 10 years, and I will show you the exact data. By the end of this video, you will know exactly when the market is about to turn, and you will know when it's time to go in with confidence and when it's time to wait. The strategy that I'm talking about is called the Unsharp. Now let's go ahead and dive into the details. Let's break down the day trading strategy called the Unsharp. We are going to start with the daily highs and lows of the chart. You want to go ahead and mark these zones because we will use these zones for our entries and exits. And you also want to mark the last 2 to 3 days highs and lows as well. We're going to be focused only on long setups on the S&P 500 or the Nasdaq. These are the setups that have been backtested from 2015 to 2023, and towards the end of the video, I will show you the exact backtested results. Plus, the stock market most of the time goes up. If you look at this stats here, 70% out of the time the stock market is going up. And this is why we want to be focusing only on longs. We're not going to be looking for shorts because we want to have the maximum probability for success and the best results. For our example, I will be using the S&P 500 futures ES, and you want to mark the previous days and lows on the chart, and I will use the last few days for our example. If you want to get more historical data or experiment with that, feel free to backtest it yourself or check my backtest towards the end of the video. Now, the reason we want to mark these zones is because they act as magnets. Most of the times, institutional traders, buyers and sellers are placing orders around these zones. For example, buyers are placing orders towards the lows of the day so that they prevent the price to keep going lower, and sellers are placing sell orders at the high of the day to prevent the price to keep going higher. This is why these zones act a lot of the times as support and resistance or as liquidity zones, and they're extremely important for our strategy. In our example, you see this was here the last 2 days high, and this is here the last 2 days low. And I also marked the previous day's high, which is here, the 3 days low, which is here. So you want to mark these on the chart, and once you've done that, we want to go on a lower time frame. Now, for our example, you don't have to trade the 5-minute, the 15-minute, or the 1-hour chart. There is no rule for that. You can use any time frame you want. And the reason for that is because our entry doesn't work like the most strategies you probably ever heard. We are not going to be looking for confirmation here. What we're doing is we're marking the zones on the chart and we're placing our buy orders right around this zone. By the way, this setup happens most of the time in the first 1 hour of the day, and sometimes it can happen also towards the end of the day before the close. So in this example, I will be placing an entry order just a few points above that low in this zone. You can mark that on the chart, and you can place the stop loss a few points just underneath. Because you don't want to get stopped out if the market is too wild and volatile, you want to give it still a little room to test this zone and you're still in it and not stopped out for no reason. So stop loss can be placed right here and your entry is a few pips above. Now, what I like doing is once the price starts going towards my direction, I immediately like moving my stop loss towards break even. This way, I'm immediately out of the risk and I don't have to worry about this position. And if I get stopped out for break even, I can place another order to get back in the market. Our target typically is the previous day's high or the high of the chart, the resistance zone. In this example, our target is here and our take profit order can be placed right here. What I typically like doing though is splitting my take profit in two. I take my first partial towards the midpoint of the range because your probability for closing for a profit is much higher if you place it here. And normally I would trail my stop or put a take profit right here at the upper part of the range so that I can maximize my gains. So in this example, that setup worked pretty well. And not only that, but it gave us towards the end of the day another entry and another opportunity. If you placed your order here again and your stop loss slightly below, same way like the first one at the beginning of the trading day, and you placed your first take profit towards the midpoint of the range and your second take profit towards the upper part of the range, you would have had two nice trades on that day. Again, we're looking for these zones that is the low and the high of the previous day or the last 2 to 3 days as an entry, because this acts normally as a support and resistance, and this is your range. So we want to be buying at the lower part of the range and closing at the upper part of the range. You don't want to be buying breakouts, or you don't want to be buying in the middle of the range because you do not know where the market is going to go. As we have a saying here, don't diddle in the middle. So what happened the next day, the market broke straight through that zone, and we don't want to be buying that high. What we're looking for is we're looking for a retest of this high. In this example, we can place an entry order slightly above that breakout zone, which is the previous day's high, and the stop loss can be placed slightly underneath. And our take profit, like in the example I mentioned, can be placed one towards the midpoint of the range and one towards the higher part of the range. You can also trail your stop, meaning you can move your stop loss at each low of the trend. So far, out of these 2 days, you had 3 nice winning trades. Now let's continue further. The day after, we did not have here any opportunity for an entry because the market went straight up and did not test the lows, and we don't want to be buying in the middle. As I mentioned, follow the rule, don't diddle in the middle, and you will have much higher probability for success. In this example, the market just went straight higher, didn't do anything, did not give us any opportunity. The day after, it actually came all the way down here. So if you put your entry order here and your stop loss underneath, you would have been stopped out. And of course, I don't want to show you just examples where you win 100% out of the time, because this is not how it works. I am showing you just the recent few days to show you that you would have had plenty of opportunities, and of course you would have been stopped out once, but I want you to go back and backtest it yourself and see the risk versus reward and how many times you win versus how many times you lose. So in this example, one stop loss. Going forward, what happened the day after is this is our low. It's been tested again. So if you entered right after the open, a few points above, and your stop loss was below, you would have still profited on that trade. So we had so far 1, 2, 3 winning trades, actually 4 winning trades, and 1 losing trade over the past 5 days. The wins should be much higher than the losing trades because you're entering at a very good price. Always when you enter towards the lower part of the range, this is here, for example, your risk, and your reward is much higher because you already have one of the best possible entries. This is why if you have a good risk versus reward ratio, you will be always on the good side. And so go back and test it yourself. Test it with the Nasdaq. You can also test it with the Max 7. They work also pretty well. But the back-tested results that I'm about to show you are on the SPY and on the Qs. and futures as well can be used for that. This is one of my favorite strategies because it has a very, very low risk and extremely high reward. And yes, of course, sometimes you might get stopped out. That's how trading works typically. Or sometimes you might not get filled. It happens as well. But the point here is overall, you have a reliable strategy with a very important support and resistance liquidity zones. And if you follow just to buy around these zones as low as possible, you will be on the winning side. Now let's go ahead and see the results that I promised. Okay, so these are the results here for the QQQ from 2015 to 2023. This is the win rate and this is the risk to reward ratio. Tested every single day the way I just showed you. So you have 60% win rate here in 2015, 2016, 62% win rate, 59. So you see overall you are winning around 60% out of the time, and your risk to reward ratio is pretty good as well. 1 to 3, 1 to 2, 1 to 3, 1 to 2 throughout the years. This is a very good result actually, because this shows you that this is a very reliable strategy over the past years, and this is one of the instruments. Now the second instrument, as I mentioned, is the S&P 500 SPY. Same test from 2015 to 2023. You have here as well the win rate and the risk to reward ratio. Win rate, same thing, around 60% win rate, and risk to reward 1 to 2 and 1 to 3. Now, something very important to mention here, the risk reward is based on closing your position towards the midpoint of the range. So it doesn't calculate if you hold your position towards the upper part of the range, and it just shows you a less aggressive approach. So you have probably a little better results if you close partially your position towards the upper part of the range. So you will probably have a little better results if you use a trailing stop strategy, or if you pretty much split your position into two. So let me know what you think about it. Did you know that strategy? And let me know if you backtested. What are your results? I would love to know. Thank you so much for watching. And by the way, if you want to get our free weekly gains guide, just check out in the description below. We send each week our best 2 growth stocks for the week and a market analysis. So feel free to check it out. I am looking forward to see you back here on our channel. Thanks again and bye.